and welcome to Macros with Mythili, the ET Now show that takes a hard look at all the major macroeconomic issues and developments in India and overseas. This week we're going to take a hard look at a market that seems to defy all logic, the bond market. One of the basic tenets of economics is the time value of money. That is, if I lend you some money today, then when you return it to me after a year or 10 years or whatever period, you will have to give me something more than what I lent. Today, however, that basic tenet seems to have broken down. Close to 30% of global bond markets are giving you a negative rate of interest. That is, you actually get back less money than what you'd lent initially. In other words, you have to pay for the privilege of lending. Bond yields in India are not negative and are unlikely to ever be so, but yields in India too have fallen dramatically. So what's going on in bond markets? We're going to try and make sense of it all with a panel par excellence. We are extremely privileged to have with us Harun Rashid Khan, former Deputy Governor, Reserve Bank of India, who's been keeping a close eye on bond markets from the regulator's perch. NS Venkatesh, Executive Editor, Laxmi Vilas Bank, and Chairman FIMDA, Fixed Income and Money Markets and Derivatives Association of India, and Anant Narayan, Managing Director and Regional Head of Financial Markets, ASEAN and South Asia, Standard Chartered Bank. Welcome to the show, all three of you. Let me start by asking each of you in turn, are you apprehensive, awed, foxed, however you might like to describe it, by what's happening in bond markets today? Noted economist Robert Shiller had warned back in 2015 that bond markets are heading for a crash. But judging by the way funds are rushing into bond markets today, despite record low yields, there doesn't seem to be any end to the fascination with bond markets. We look at Indian and global bond markets separately because the dynamics are quite different. But what is your first take on bond market overall? Let me start with you, Harun, and I'd also like to thank you specially for joining us in ET Now for your first interaction with media after you stepped down in May this year.
Thanks, Mythili, for giving me this opportunity, even though I have retired now. Let me take some shot at the global bond market. As you know, we have a large segment of global bond market, either very low rate of interest or negative rate of interest, and partly because of quantitative easing and accommodative policy. The whole idea is to promote growth, and as inflation is not picking up, so use this. But this instrument of negative rate or very low rate, I am not sure how long it can work and what will be the implication of that, whether it is serving the intended purposes. Of course, it will have implication for banks' profitability, to take the first point, because the retail depositors, socially and politically, they can't bring it below zero, they have to make positive. They may get some benefit out of wholesale funding, and so their margins will be stressed. If they don't able to lend, the margins will under stress, so that is profitability of bank. The second issue is the long-term savers, pension funds and endowment funds and insurance funds. They have very low and negative rate, and how do they service the investors and savers? So that becomes an issue. And third issue is this negative interest rate or the low nominal interest rate has a connotation of competitive devaluation. So where this competitive depreciation or devaluation will end, we don't know. Of course, emerging countries like us, we do get benefit because of this low negative rate of interest. We get flows, but how long this will continue, we don't know. And if it is not done calibrated manner and not done in a smooth manner, we could have a problem, because advanced countries are riding a tiger and they don't know at what point of time they should get out of the tiger. So this is an unknown and unpredictable trajectory we are moving. So one has to be very careful and watchful about how this negative or low interest rate plays. So bond yields, the way the bond yields have fallen and the prices have gone up, possibly quote unquote it could be a bubble. I am not sure whether the bubble will burst immediately, because given that what Germany is doing, what Japan is planning to do, and way US will also do, given the rest of the world what is happening, they may not raise the rate so quickly. It may not happen, but at some point of time when they start tightening, when the inflation starts peaking and growth picks up as it is happening in US, then there could be huge repercussion in terms of MTM losses for banks, as well as reverse flow from the EMEs to the advanced countries. So we had this experience of 2013 how bond market played. So we have to be very careful and watchful about what is happening in the bond market overseas.
Venkatesh, do you agree with Harun that it's a tiger and it will be very difficult for us to dismount? What is your quick take on the mayhem in the bond markets, both as a banker as well as the head of FIMDA?
See, I personally believe that essentially moving into a negative interest rate territory is quite dangerous, in the sense that the thought process is that it will spiral the demand, aggregate demand, and then based on that the economy will recover and the job losses will all go away. But if we have looked at it, nothing has happened in those countries for quite a long time. So the central bankers' policy of keeping the interest rates low or very negative doesn't give that sort of an impetus. On the contrary, it actually brings into the fore more risks into play. The second thing is, like, let us say the retirees, those sort of people, they will stop spending. The consumption will go down. So and start saving more, because in any case they are not earning much. So to that much extent, maybe the aggregate demand will actually slow down. So it's really a tiger. We have caught the tiger by the tail, and we do not know when to let go of the tiger. It becomes very, very difficult as a central banker also to manage it, and as a normal bankers will have lots of problems, in the sense that if you keep on piling up those securities as part of your investments, and when the interest rate turns, then it could get into the mark-to-market losses, and those sort of things can happen. So I personally believe we are treading dangerous ground, but most of these things are happening mainly because of the safe haven, in the sense that people tend to put the money back to the central bank or to those sort of government securities, thinking that it is a very safe security, so let me at least keep it there, so that at least I don't lose the money by putting it onto some riskier assets. But it is a very, very dangerous trend that we are seeing.
Very, very dangerous. Anant, both Venkatesh as well as Harun use very colorful phrases to describe what's happening on the bond market. Do foreign banks have a different perspective?
No, I think both the points that Khan Saab and Mr. Venkatesh made are, would find a lot of consonance with global views as well. To go further, I think the reality is we are in uncharted waters. We are in unprecedented times, as you said, $12 trillion worth of bonds which are now yielding negative rates. I believe 70% of outstanding bonds right now in the market, sovereign bonds, are below 2% yield. So clearly this is very, very different and challenging times. But I would, just to put a perspective on why we are where we are, and why is there a fascination for even negative yielding bonds, which makes no sense at all from a commonsensical perspective. I think we have to put things in perspective. When the 2008 crisis happened, particularly in the West, you had a situation where households and corporates were terribly leveraged. And there was a crisis that a lot of banks, corporates and households were risking going under. Now what happened as a result of all of that? Obviously global growth was crunched down. And then the central banks and the government stepped in to try and fill the breach and provide some relief to the household and corporate sectors and to the banks. So what happened was central banks expanded balance sheets. The Fed has increased its balance sheet 4 times since 2008. Likewise with Japan, the BOJ now has a balance sheet which is 80% of Japanese GDP. Likewise, Western government debt also went up because they were trying to pump up the economy. On the other side of the Pacific, in China, because global growth was going down and they wanted to maintain growth, you had banks lending more and more to the corporate sector, funding more and more investments, and trying to keep up growth. So banking loans from China went up from 1.5 times GDP in 2008 to now about 2.5 times GDP. So what's happened is the corporate sector and households in the West are actually looking pretty healthy right now. Household debt in the US has actually come down. Corporates in the US and Germany are sitting on record levels of cash. Now the most benign outlook out of all of this is maybe corporates and households start to spend again, GDP growth goes up, and that GDP growth can start to fund some of the fiscal deficit and the central bank balance sheets which have been built up over time. That's the most benign way out of this. Unfortunately, given the crisis of confidence in China, the crisis of confidence in Europe, the crisis of confidence in commodity markets, there simply is no confidence amongst the people who have the ability to spend, to actually come out and invest or spend. So you still have $2 trillion of cash being deposited by American banks into the Fed every day. You still have American companies sitting on $2 trillion of cash, not spending it. So, and we have gone into this kind of a vicious loop where spending is not happening, so GDP growth is not coming, and therefore government debt is remaining where it is.
So it really is a very complex picture. But Harun, moving to domestic markets, is the overseas money that's coming into India looking for trading profits or stayed interest earnings? Because if one accepts, as most people do, that the scope for further interest rates reductions and hence for trading profits is limited, so it is the yield differential that's driving inflows, then does that mean that these funds are coming from new kind of long-term players, sovereign wealth funds, etc., which might be better for India and might take away some of the stigma that's attached to debt funds, that it's easy come, easy go? Harun?
Mythili, the question was about opening of our debt market to foreign investment, foreign participation, and getting into the bond index. I know some people have very strong views, including Anant, who has been advocating it very vigorously. A couple of points here. One is, we have now put out a predictable path of opening both GSEC market till March 2018 will have 5%, and for the state development loan 2%. So this is a huge improvement over the earlier regime where there was no predictability. Second thing is that we have denominated everything in the rupee terms, so that there is no problem in terms of exchange rate fluctuation. And we have a bias for the long-term investor. That's why I told you we have a separate quota for long-term investors, and we want not less than 3-year maturity money to come. But full opening and getting into index has implication of this volatility coming, and we have this experience of taper tantrum of 2013 when 6-7 billion just flew out because of what happened elsewhere and not so much of our fundamentals. So one has to be little careful and calibrated while opening. I know there are arguments about bond index. We looked at some of them, but they wanted complete opening. But the other possible way is whether we can open 1 or 2 bonds fully for the foreign participation. One option could be long-term bonds beyond 20-30 years, whether you can totally open for them for the foreign investors and see how it works. I think this is something probably RBI will look at. 1 or 2 securities fully opening fully for the foreigners, and see that what is the interest and whether this satisfies the bond index providers. I think this is something
going to toss
probably
that
RBI
same
will
question
look
to
at.
Anant, because if it is indeed longer term money that's coming into India, does that really build a case for what you have been arguing for long, a further relaxation of limits on FII holding of government securities? Anant?
Yeah, so just to, I completely agree with the points that Mr. Khan again made. But just a quick thing on the foreign investments. I think India has the privilege of being in a different spot from the rest of the globe. I painted a fairly bleak picture of what's happening globally. But if you look at India, we have a situation where our macros are in fantastic shape. We have a situation where there's actually investment coming through from the government on the roads, on irrigation, on defense, on various infrastructure projects. We have a situation where monsoon is looking up, and therefore rural demand might actually go up. And we have a situation where reforms seem to be happening. Hopefully GST will come by. We're already seeing a lot more of small micro reforms, including financial inclusion, go by. So a lot of good things are happening in India, which is acknowledged by the world. And plus, let's remember, at 7.25% for 10-year, we still offer a good 140, 150 basis points of real interest rates in India, at a time when our macros are looking good and the country is looking relatively good. I must put the caveat that things can change. We will be hostage to what happens globally. But genuinely, the India context and future is looking a lot more brighter in comparison to the rest of the firmament. Now, coming back to, should we open the floodgates? No, we should not open the floodgates. In fact, even at current levels, we have about $25 billion of money into bond markets. The Governor Rajan has indicated that he wants to increase the limits from currently 3.5% to 5% over time. We do need the money for our investments. We need $2 trillion over the next 5 years for infrastructure. But if we get it in the current shape and form, we have a problem. The starting point is Indian bonds should be part of global indices. Just as Indian equities are already part of the global MSCI indices, you have to have Indian bonds as part of global indices. Only then will real money funds from Japan, Europe, US actually put in passive long-term funds into India, and it would just not be, you know, hedge funds bringing in short-term money and taking out money at the first sign of trouble. So we have to work on that, and there are solutions around that. I know the government and the RBI has issues around getting bond inclusion into the indices, but there are solutions around that. Once we get that, we can be a lot more open in terms of allowing inflows to come in.
Okay, but let me just bring in Venkatesh on that, because agreed, Venkatesh, you know, Anant has been arguing, in fact earlier also he's argued about the case for India to become part of a global bond index. And the fact is that yes, we haven't come to any great harm by allowing greater FII holdings in government securities, but does it not increase our vulnerability, especially since our forex markets are so thin? So any en masse sellout by FIIs would have repercussions not only for the bond market but also for the forex market. So should we be more wary about increasing these limits regardless of whether we are part of a bond index or not? Venkatesh?
Yeah, I tend to agree with both Khan Saab and Anant, but the view is that when we need to fund the infrastructure and the local capital is not enough to do that, we need to attract the foreign capital inside the country. And the foreign capital will look at investing into those countries where there is ease of doing that investment and the benchmarking is possible. So to that much extent, if you are trying to attract the long-term investor, and one of the needs of the long-term investor is to that it should be within the benchmark sort of thing, and the indices should be there, we should be forming part of that indices. But let us assume that if you have to open it up and put the entire thing into the index, maybe at this particular point of time the government as well as the central bank might have its own issues. But can we think of, let us say, only one security, let us say the benchmark 10-year security, only we put it into the index, so that you attract that much money into that particular script, and those who are willing to come through the index route, or if it is coming into the index route, they come in that, and those who are even otherwise investing into our Government of India securities, they come to the other securities part. So I think we need to bridge that gap and try to think as to whether we can put a part of the security or part of the government borrowing program, specified security, into the index.
Let me just interrupt you there for a moment, because it's time for us to slip into a very short break. But please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and we're discussing the mayhem in bond markets with an extremely wonderful panel that we have with us. Harun, has monetary policy become irrelevant as far as bond markets are concerned? Because not only are interest rates ridiculously low, but even the yields on US Treasury bills, 10-year Treasury bills, actually fell after the Fed hike rates. Likewise, in the Indian context, the 10-year G-Secs yields rose after RBI cut rates earlier in the year, and now they've fallen without any rate action. So is monetary policy completely redundant?
No, it is a combination of that. In fact, last 1 month or so, to 20 basis point it has fallen, and one is, of course, as I mentioned, liquidity is certainly a factor which contributes, and given our macro and growth story, though, there is an attraction for our bond market, and we have over time built volumes and depth in our bond market. Volumes are pretty high on many days, and we have a bid-ask spread of very low in the liquid paper, and impact cost of doing large transactions has also come down. So these are all factors, both liquidity, monetary policy stand, growth story, and what is alternate option available for investment overseas, all are contributing to that in terms of attractiveness of Indian bond market. So and also if not monetary policy action of RBI, monetary policy action of central banks of advanced country, if they continue to do lower negative rate of interest and we provide a stable macro and environment, and naturally we become a preferred habitat for those funds to flow into India. But nevertheless, we will be very careful. We will not like investment tourists to come to India. We will certainly prefer long-term investors. That is why we have that 3-year residual maturity requirement.
Absolutely true, Harun, you're right on that. But Venkatesh, what to your mind explains the recent fall in G-Sec yields at a time when there was so much worry that the oversupply of bonds, thanks to schemes like Uday, was supposed to do quite the opposite? Is it, as Harun says, not just monetary policy but liquidity, monsoon, a whole host of factors that are driving interest rates down? Venkatesh?
Yeah. essentially what has happened is it's a liquidity driven rally, in the sense that earlier you had a deficit liquidity mode, but with this monetary policy announcements of moving into the neutral liquidity mode, I think that has given the sort of an impetus, and the system is I would say partially surplus with liquidity at this particular point of time. So to that much extent, the liquidity is driving the rally. The credit offtake in the banking system is much slower. The deposits are trickling in. So naturally, the bankers will have taken that position of putting the money into the government securities. Coupled with that fact that the calibration for the liquidity coverage ratio, where you need high quality liquid assets, are there. So for the demand for the government securities is also much more higher. So I think coupled with all these things, I would say has brought the yield down. But we also need to take cognizance of the fact that the monetary policy has played its part, in the sense that when you cut the rates, or when your expectation of cut in rates are there, that will also drive the rally. So here I would say, one, the liquidity plus the expectations of further cuts into the monetary policy is pushing the yields down. So naturally, the monetary policy also has played a part in driving the yields down.
How long do you see these low rates continue? Because the fact is that interest rates seem to be quite out of step with macroeconomic fundamentals all over the world, because we see both governments and corporates are heavily borrowed, and yet yields seem to only fall. We see the US Treasury now down to 1.39, down from 2.27 at the start of the year. So what is the connection really between macroeconomic fundamentals and interest rates in today's world?
The reason why rates are where they are is because global growth has been abysmal. You know, for the last 6 years, since 2010, each year we start the year with assuming a certain amount of growth, and we end the year at growth rates far lower than what the original expectation was. This year is no different. World Bank has already said that global growth will be 2.4%. IMF has said it will be down to 3.1%. So again, it seems like a dismal growth. And because growth is not happening, actually corporates in the US are not badly off. The whole system as a whole, not just tech companies, but the overall firmament of corporates and households in the US are actually quite liquid and capable of spending. Except because global confidence is low and geopolitics is so murky and local politics has become so kind of exclusive and inward looking as well, there simply isn't confidence amongst the corporates who are sitting on cash or households to do excessive spending. Otherwise, look at the macroeconomic fundamentals even in the US. You know, your jobless claims are at multi-decade lows. Your NFP numbers have been extremely strong, barring a few blips here and there. Therefore, unemployment has come down to low levels. Things are actually looking better, but the US growth is simply not happening. So as I said, we are in this vicious cycle where now governments and central banks are sitting on tons of debt which they've absorbed from the private sector. Households and corporates in Germany and US and maybe even in India, which are capable of spending and starting an investment cycle and a consumption cycle, aren't doing so, and therefore are preferring to keep the cash idle. And that's leading to low interest rates. Now, we have to get out of this morass. Somebody hopefully will start to spend somewhere. Maybe confidence comes back in the US. Once that happens, then global growth comes back, and that could hopefully, you know, cushion some of the problems that we have currently. Until then, we are where we are. But I must hasten to add, India, I think, is in a better off spot by far. Real rates in India continue to be positive. Not many countries in the world can claim to that right now. I think the investment cycle is already underway from the government side. Hopefully, private sector side will start to participate as well. Reforms are underway slowly but surely. I think overall our prospects are looking good. With a bit of help from more reforms and a market which is supportive, I think we should see good times ahead. Achhe din aayenge. The only one bit I'll add to you on this debt versus equity FI inflows. One statistic I'll add, which is, you know, we have about $50 billion of money coming in through portfolio investments into debt, both government and corporate bonds. The portfolio investments in equity is over $300 billion. All I'm saying is there is a problem here where we are a lot more, you know, we are open to selling our family silver and selling ownership into corporates rather than borrowing at a time when we are growing so rapidly. So I'm not suggesting by any means that we open up our markets to wholesale debt coming through. Obviously, debt flows can be a lot more volatile. But if we are part of indices, if we can excite real money, long-term investments to come through by being part of indices, and correct the lopsidedness a little bit, I think we as a country can do a lot better.
Okay. But I'm afraid we've completely run out of time, so I'll have to end this very lively discussion. Clearly, there's much more to the normally state bond markets than most of us would have given credit for till very recently. In fact, I can't think of a better way to end the show than by quoting James Carville, his strategist for the former US President Bill Clinton's presidential campaign, and he said, "I used to think that if there was reincarnation, I'd like to come back as either the president or the pope. But now I want to come back as a bond market. You can intimidate everybody." Thank you, Harun, Venkatesh and Anant, for joining me in this very lively discussion. Thank you also for watching. Remember, we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at ET Now.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.